Good morning, everyone, and welcome to our webinar this morning, where we're joined with Georgina Carpendale, who is CFO of Fitzgerald Power. So Georgina is an experienced finance executive, having worked as Chief Financial Officer in a number of companies, most notably in fast-paced, innovative startup companies. Georgina's experience includes capital raising, company restructures, and establishment of international subsidiaries. So Georgina has been drawn to startup, scale-up companies due to the challenges and thrills that come with a growing company. So I've noted that all of her insight on raising funding will be hugely beneficial to everyone today and preparing your company and your business for investment. So my name is Christina McGreevy. I'm the Client Services Manager at Accountant Online. We're a firm of chartered and certified accountants, as well as company secretaries. We support businesses with their compliance, payroll, secretarial, bookkeeping, and tax needs. We're an award-winning practice and most recently recognised by Xero as Partner of the Year for the third year in a row. So I want to just note that this morning's webinar is for general information purposes only. We do advise that for anything specific relating to your business that you do seek professional advice. That being said, I'll pose any questions that you have to Georgina throughout the webinar. So do use the question and answers feature, and do use the chat feature for anything that you want to share with us there, or any questions that you have, and I'll post them to Georgina throughout. So I'll hand over to you now, Georgina, and you can go over the topics that you'll be discussing and start your presentation. Thanks for that.
Lovely. Thanks, Christina, and welcome everybody. Thanks for joining me today. So I'm just going to cover off on a few different things. I will be keeping it pretty general. But what I did want to do was just give you a little bit more detail on the types of funding that are out there. And I'll focus on private equity and venture capital, because I know when I was starting out and raising funding, I wasn't quite sure what they meant. It may not be applicable for you now. Down the track, it may be. And then we'll really get into a bit more detail on preparing your business and getting it set up for funding. So just a little bit about myself. As Christina said, I'm CFO of Fitzgerald Power. So we're a fully serviced accountancy practice, and we have a corporate finance division as well. So I'm the CFO in the company. I'm not on the client advisory side. I suppose I've been sitting in your shoes in my previous positions as CFO, and I've worked in listed and unlisted companies. And a big part of my role there really has been around getting the appropriate procedures in place, setting companies up for their scale up and growth path, and getting the necessary funding in place. So I hope I can give a little bit of my experience and knowledge and what I've learned over that time. Obviously, a key focus of that has been the financial modelling side of things, negotiations when you are signing up different contracts or structures as to how it will look for you from a funding perspective. So we might just get into a little bit more of the detail now. And I just want to give you, I suppose, a brief overview of private equity and venture capital within Ireland, because it's good to have a little bit more of the understanding there. So private equity, what we have seen is Ireland is an attractive destination, and this applies both for PE and VC. There is skilled workforce within Ireland, and the access to European markets and also the US market as well. Ireland is very well positioned. PE, they invest in various sectors, and this isn't an exhaustive list. It's only a few areas that they do invest. So technology, financial services, healthcare, but depending on the mandate of their fund, they could look at other sectors to invest in also. What we're also seeing over the last few years is private equity and VC as well, there's a growing interest in sustainable and impact investing, where they are looking at ESG considerations within businesses. And I don't mean that a product or a service that your business is carrying out is a sustainable product, or that you're in wind turbines or anything like that. It's just that within your company you are considering ESG. What are you doing for that social and environmental side of things, and are you putting things in place there?
That's really interesting insight as well, then, Georgina, isn't it? That has to be a key focus. It's not just a matter of that's a long-term plan. If you're dedicated to getting that funding, those that are looking to invest will have an interest in what you're putting in place for that.
Exactly, and a lot more mandates for funds are setting that out. So it is important that businesses are thinking about it.
Mm.
And even if you are a small business and you can't make a huge investment in ESG, as long as you're doing small things or you're identifying things that you can be doing going forward, and are trying to put them in place, it'll really stand to you.
Mm-hmm. Great. Thank you for that insight as well. That's very helpful.
So then if we just chat a little bit about venture capital in Ireland, and look, some of this is an overlap of private equity. Venture capital, they do tend to invest in startups in the technology and innovation space. That's where they're more focused. But again, it doesn't mean it's the only area that they invest within. There are supportive government initiatives as well, which allows for VC investment. We've an excellent ecosystem through our universities, research institutions, and technology clusters within Ireland, and a really highly educated workforce in technology and engineering. And similar to PE, the strategic location of Ireland, we are very lucky with where we're based, and we've seen that's why a lot of companies set up here and get funding in Ireland.
Great, thanks, Georgina. And in terms of that the VC, what type of government initiatives are you referring to there?
So I suppose for companies and even for investors, there are tax incentives, and grants, and there's specific funds set up as well. So Enterprise Ireland, who is the government agency, and they're responsible for promoting Irish enterprises in the world market. They do co-funding with VC funds and private equity and other investment funds as well. So reaching out to Enterprise Ireland when you're at the stage for them to take you on is worthwhile, because they provide support to companies as well. And similarly, the Irish Strategic Investment Fund, they do co-funding with VC and private equity funds as well. So there are other options out there. And it has even been said that Enterprise Ireland is similar to a VC, and they really do invest in a lot of Irish companies.
Yeah, okay, great. Thank you. So there's a lot of support out there as well, essentially, when you're starting this journey.
There is, and if you're not at the point where for export, or it's not a plan for your business, reach out to your local enterprise office as well. There is support there, and there's great support as businesses are starting off.
Yeah, absolutely. And we do a number of webinars with Leo, but yes, they're huge support to those sort of early stage businesses. And as you say, depending on what your plans for the future are, if you're planning exports, then Enterprise Ireland can offer huge support there.
Support, yeah.
Sorry, I'm digressing now. I'll let you go on.
No, and it is important because it's not just the support from a funding perspective, but if you're writing a business plan for the first time, marketing, the support is there across a number of different areas.
Absolutely. Yeah, great. Thanks, Georgina.
Not at all. So I'll just move on. And what I just wanted to do next was, again, give a brief overview of what exactly is private equity and what is venture capital. What types of company do they invest in, and when do they invest? So private equity, they take much more of a focused approach. So they tend to acquire more of a significant ownership in a smaller number of established companies within their fund. So they do look at companies that have already been established. They're open to various industries. Again, it will depend on their mandate for the fund. They like to see companies that are generating revenue, have a business model that has already been proven, their stable cash flows, and where you can prove or show the financial performance of the company as well. As I mentioned, they do large scale investments because they are looking for a higher equity within the business. Their risk is lower, which is why they are investing in established companies. Where they try to generate their return is they actively work to improve the operations, increase efficiency, and drive growth within the business. So they will work a lot more closely with the company. Then they tend to set the company up for an exit event, which generally could be a sale to a strategic partner, a sale to another private equity firm, or an IPO, so an initial public offering, so listing on the stock exchange. Private equity, usually they have a finite life of holding their investment 7 to 10 years. They ideally like to get out around that 5-year mark, but it will depend on how much value add they have created through that increase in efficiency and driving the growth of the company over that time. And they'll bear it in mind with other investments within their portfolio as well. So that's private equity. Then if we look at venture capital, they will come in at an earlier stage. They like high growth potential companies if it's a tech-driven sector. But as I said previously, that is not the only focus for them. Because they come in pre-revenue or early revenue stage, they actually use a principle called the Pareto principle. And essentially what that is, it's 80-20 rule. So 80% of their revenue is generated from 20% of their portfolio. So that's just a little bit of a guideline. And what that means is a large number of their investments, they expect a small number will return the majority of their profit. And what the hope is that those really successful, be it unicorn investments, can potentially offset losses from unsuccessful ones. So they will have a much wider ranging investment portfolio. Their investment size, they will do smaller amounts because they are coming in at that earlier stage of investment. They will also make larger amount investments as well. And you see companies like Sequoia investing larger amounts. They are much riskier in their investments, and because of that 80-20 ruling, that's how they try to alleviate their risk. And similarly, they will obviously have an exit event in play, and they'll be looking for a sale or an IPO. With VCs and holding their funds, depending on when they come in, they would like to try and see a return within 3 to 5 years, but if they come in at a very early stage and depending on the portfolio and how the company is operating, they may stay a little bit longer, but ideally would like to get out after the 5 years.
Okay. And so would that be tied to sort of that the sale, that sort of 3 to 5 years, and that's where they would see that they'd have the maximum return opportunity? And can you tell us a little bit more about sort of what type of returns the likes of private equity expect and the venture capitalists expect from a business?
Yeah, so for if we're looking at a multiple of capital or a multiple of money, so what was their initial investment and what will they get out of it at the end? Private equity like to see somewhere between 2 to 4x of their initial investment.
Okay.
VC anywhere from 3 to 10x. Again, it depends on the type of investment, at what stage they came in as well. They'll
Okay.
also look at their internal rate of return. So that's looking at the cash flows and the growth over a number of years. And for that, private equity, they can look for a return of 15 to 25%, maybe more. VCs, they look a little bit higher, maybe 20 to 30%. And again, it depends on what stage they came into that investment, what time frame they've also been holding it. But that's a little bit of a guide as to the parameters they look at.
Okay, okay. I'm sure that's really helpful to all of our attendees as well. So thank you for that, Georgina.
Not at all. So I'll move on, and I hope that will give for people that didn't really know what private equity or VC was, just a little bit more of a background about them, whether it's applicable now or not.
Mm.
So I might move on to just preparing your business for investment and what you should do.
Yeah.
What I've tried to set out here is items that you can be doing from the very start. A lot of this you'll be doing naturally as you're setting up your business, as you're growing your business, but it's good just to call it out and chat it through.
Yeah, and Georgina, from what I can see from our attendees, most of them have said that they're at the early stages or operating between a year and 2 years. So I would say this would be quite particularly helpful to them to sort of understand the steps they need to take to prepare their business for investment. So yeah, thank you.
Great. So I, where possible, I've kind of put it in an order that you would take, but it doesn't mean any one has to be done in a specific order necessarily. So obviously evaluating your business, looking at what are your strengths, your weaknesses, what's the growth potential of the business, looking at your financial performance and market position. So really get a good understanding of your business and be able to articulate it and document it is really important. For your product or service, where possible, try and validate it. So obtain customer feedback. If you can generate early sales, but anything you can do to demonstrate traction and market demand for your product or service will stand to you. And if you can easily present that then in a funding round, even better. I know some companies where they're at product development stage, and in the companies I was in, they were we were mainly engineering and tech based, so we were often in development stage. So for us, we were either pre-revenue or very, very early revenue. So what I would recommend, if you can't generate early sales, is go out to your potential customers, gather their feedback on what your offering will be, even if you have prototypes that they can play around with, just so that you can show you're filling a gap and a need that's out there. So the more support you can provide, the better. So once you've all that set out, clearly set out your business plan. Your business plan should be setting out what your vision for the company is, your growth strategy, your financial projections. And I know many will do this at the start, even when they're thinking about setting up their business. But my recommendation would be set out your business plan, but make sure you have steps as to how you're going to achieve those goals. Because a lot of people will prepare a business plan because it's a tick box. And if you're getting initial funding from a bank, it may have been requested, but really use it and set out those steps that you want to achieve. Go back to it regularly, quarterly, half yearly, reassess it. Are you still on track? Do you need to pivot it? And I would be doing that as early as possible in your business journey and continually updating it. The next part, I suppose, is strengthening your financial reporting. So ensuring that there's transparency in your financial statements, your financial accounts are accurate, that you have processes and systems in place that will allow you analyze different financial analytics, look at things from a different perspective. Now, you may not have the resources within the business, and it might be somebody, particularly very early stage, that's just doing your bookkeeping or that is outsourced. When possible, I would really advise that on a quarterly basis, if doing it monthly isn't possible, get somebody external that can bring your accounts to that next level, that can help you really assess them, not where you're just getting your bookkeeping and your accounts done, but can give you that extra value and insight into your financial statements and allow you to assess your business from different aspects. So part of that is actually also streamlining your operations and processes. I think where you can improve efficiencies, if you're scaling your business, how are you going to do it? What processes do you have in play? Taking a step back, look at how things are being done. Are there lean processes you can put in place? And that doesn't only have to be from a manufacturing perspective, that can be throughout your company, from marketing, supply chain, general operations throughout the business as well, where you can identify efficiencies. If you are in a position and you have cash there, put in the effective systems. Part of your funding may actually be to invest in appropriate systems. So again, if you've done the preparatory work, identified the gaps and the needs, you can then articulate that to a potential investor, and you can show them this is what the use of funds are for and this is the improvement it will make. So it's not the job that you'll do on streamlining operations will stand to you, whether you're funding or not. It's all business improvement.
And it sets you up for scaling as well, Georgina, doesn't it? Yeah, and that's what I'm sure investors are looking at. They want to see that, is your business scalable? Is it set up for growth, you know? And as you say, that sort of streamlining your operations and processes, if you do that right from the start, or even identify what systems your ideal state would be, you know, it makes such a huge difference, doesn't it?
It really does. And it also shows that you're organized, you're putting those foundations in play, and you've really thought about how you're going to grow and expand the business.
Yeah, absolutely. Great.
Another key, I suppose, focus is building a strong management team. So similar to with streamlining your operations, you want to be able to show you have a capable leadership team. that the leadership team are going to be able to execute on the plan you've identified on your growth journey. So identifying talent gaps is important as well. Again, some part of your funding may be to put people in those seats, but it's worthwhile assess where your talent gaps are and what is needed to bring the company to the next level. Depending on the type of investor that you're approaching as well, they may have the expertise, and as part of the funding process or how you structure it, they could be there as somebody you can use from their experience. They may want to join the company at an executive level as well. Then your larger investors, like a private equity, they can help you build out a management team as well if you feel you don't have it or you're not at the stage to really invest in it. It's important when you are growing the business that you get the right people on the bus and that are there for the journey, particularly if you're growing significantly. It does take a lot. As Christina mentioned at the start, I've been in startup and scale-up environments. It is go, go, go. It doesn't suit all personalities as well. But in saying that, you also need people that are there to get the job done. So it's finding that right balance is really important. Now, for anyone that has intellectual property, if you can patent it, try and do that as soon as possible, so that you're showing you've secured your asset. In some instances, I know companies don't want to patent because there might be a secret sauce that they don't want disclosed in patent applications as well. So just think of, are there other alternatives that you can protect your IP? It goes further than just product development. Look at your website. Have you got all your domains locked up for specific countries that you want to go into, even within Ireland? Have you tweaked the names slightly, just so you are covering your own assets? Similarly with your logos, trademarks, if you can get them registered, fantastic. Again, it doesn't mean people won't use them, but the more protection you can put in play, the better. So that's a lot of, I suppose, what you would be doing before maybe you're even thinking of funding and just getting your business up and running or scaling it, plans to grow the business. So now you're at the stage where you're thinking about investing. So what should you do? Try and understand the investment landscape as much as you possibly can. Research the type of funding that's out there. And what I would say is align your business vision, your business strategy with potential investors that have a similar interest. So if you are in the retail clothing space and you are looking at potential investors who only invest in medtech, they may not be the right investors for you if that's all they do. More than likely, your vision and what you want to try and achieve isn't going to gel well. So really research what types of company the investor generally invests in. If you are looking at more of a high net worth investor where that information isn't easily Google, ask the question. It is really important that you do have that right investor. Hopefully you're in a relationship for a long time. You can use them to bounce ideas off of. So invest the time in looking at the investment landscape for you.
I think that's really key as well, Georgina, isn't it? You know, that it's not just saying yes to the first investor that comes, you know, knocking at your door, but actually realizing that you're going to be in a relationship with this person for a period of time, and that you want it to work both ways for you. So if you need them to be an advisor, and as you say, bounce those ideas off, if they have industry insight for you already from their previous investments, then it's gold dust, isn't it? So that's
Yeah, it
yeah,
really is. And if it's somebody that has been on that journey beforehand, um, it's just invaluable the experience they can pass on.
absolutely.
No, and in saying that, so say for example, if I use the example of retail clothing shop and that's your company, it doesn't mean you wouldn't have an investor that has some tech experience or investment, because
Yeah,
that
indeed.
could be used in other elements of your business and take it to the next level. But it's finding the right synergies between the investor and the company and what you want for the vision and growth.
Hmm. Absolutely. Great. Thanks.
Um, so getting your professional advisor and advice, a lot of people, and I know some people say, I'll do the funding round myself. I have seen it happen. Um, my recommendation is you are much better off to engage an experienced advisor. The process runs much more smoothly. They have done it 1,000 times over. They will prepare you and give you the guidance for what you need in deal structuring, how to present, what you should be presenting. Um, they can go over questions with you that they see being asked on a regular basis because they are out there, they are attending these pitch decks and presentations. So it is really important. Um, Refining your business model and financial projections. So again, as I said earlier, you should be going back to your business plan and really updating that on a regular basis. When you're in the funding round, I would do a much more deeper dive on it. If you are looking at scaling your business, make sure that's set out. Do you have a new innovation? What is different? What is it that your company is going to make a difference or be different to the competitor, and what is your market fit in that? Um, when you were setting out your financial projections, because at this point you will be looking a number of years out because you'll be evaluating the company, and I'll touch a little bit on that shortly. But it's important to set and develop realistic financial statements and valuations that you can support it. And what I would recommend is look at your base case, then look at the upside of that and the downside, and it'll give you a better understanding. If an investor, when they come back, they will do their own review of the financials and make their own assumptions. So if they undersell, but you feel, no, I can reach the base case, if you've done that yourself, you can articulate why you think it's achievable. And then even up to that upside, if you can really explain why you can get there and how you can get there and with their support, if you don't do the prep work and you are just, saying, right, we're going to hit the moon, then investors are going to know, and they're not going to take you seriously or take the investment seriously either. So really be realistic, be ambitious, but be realistic and ensure it's achievable.
Yeah, that's it. That's so important, isn't it? You know, if they feel that you're too aspirational, let's say, and that it isn't grounded in sort of realistic projections, then it would be challenging for them to align with you as an investment, because they want you to sort of have a focus on your finances because that's where they're going to see the return as well. So, but it has to be grounded in this is what's achievable growth for us.
Exactly.
Mm.
And again, it will give them more confidence in
Yeah.
you, in the management team as well. So it's important.
It all ties together, doesn't it? Understanding those financial projections, but also sort of looking at like starting from the basics and understanding that financial reporting, having your business plan, having your projections, having your business model. It does all tie in so that it tells a story for any prospective investors, really.
It does, and that really then leads in actually to the next point.
Okay.
It's tying all of that together for your investment thesis, where you're highlighting that growth potential and your competitive advantage, how you're going to create the value and earn the returns for the investor.
Mm.
And this is where a professional advisor really comes in as well, because they can pull that together for you to tell the story. And you may tell the story to different types of investors. So how you might present it to a high net worth versus private equity or VC, maybe slightly different.
Mm.
The information and the data is the exact same, but how you might present it and what they're looking for to get out of it, and the story might be, the presentation might be different.
Okay. Okay, great.
And again, so out of that investment thesis, that is your pitch deck. So where you are highlighting market trends, the team expertise, key metrics as well. And again, as I was saying, that's where certain key metrics might be more important to a private equity, and there might be other ones for a high net worth. So you will highlight the key ones for those. The next one, and I know it's towards the end of this list, but I would actually recommend you doing this as soon as you possibly can and all throughout the early stage of the business, is get out there, network, build relationships, because what you don't want to do is when you decide, I want to raise funds, then you're going out there and nobody knows what your business is, who you are. Whereas if you're out there networking and building those relationships earlier on, then when you come back, and it could be a couple of years after you come back, but if they've heard of you before, it'll ring a bell. You're not completely new to them. You never know. Some of them may have been keeping track and watching what the business has been doing as well. So get out there as soon as possible. And I know it's difficult when you are starting a business, when you're scaling it, if you're in that high growth phase, there's so much happening within the business that you often go, oh, I don't have time to attend networking events. But in the long run, I do believe it would be beneficial. And then, so I suppose the final part really is, we're jumping a few steps. You're now in your funding phase, and you're preparing for due diligence. So due diligence is where the potential investor, they will come in, what you've presented to them in the pitch deck, they will then take a look at it, at the financials, the supporting documentation, information on your customers, your market validation. They'll get into that detail, and usually you'd set up a VDR, which is a virtual data room, and you can allow access to potential investors to the information within there. And again, if you are prepared and you've done everything that we've spoken about, and you can easily pull those documents and put them into a VDR, particularly when they're asked and you are responsive, that again will give a potential investor confidence in you and in your business.
Okay. And what would be some of the standard categories that you would see, Georgina, in that VDR? Is that where all of your due diligence would sit, all of your business model, business plan? Tell us.
So yeah, so if I, for example, if I take maybe a seed round of funding, you would have, so your pitch deck would be in there, information on your team, and so an org chart, maybe additional information on key personnel, information on your product, so a product overview, service overview, product roadmap. Again, in the services side, if there are add-ons that you're planning to do, I would set that out there. Any key metrics that you have identified, and information then on your customers and competitors. Now, with a VDR, it does depend on the level of funding that you're looking for, and that's probably a very standard list and information that you would disclose. If you are looking for significant investment, and I suppose particularly with private equity and VC, they may get into a lot more detail, but you are talking about a much higher level of funding at that stage. And make sure, obviously, and your advisors will have put you here, people should be under non-disclosure agreements, because you are disclosing a lot of private information. And with a VDR, you can lock down the time frame that somebody has access to the information, and if you want them to download the information or not as well. So talk that through with your advisor.
Okay, great, Georgina, thank you. Is there any other considerations, I suppose, from by owners or founders that they should make before raising capital?
Yeah, I suppose there's probably a couple of things. Timing is crucial for when you're raising money. So what I would say is, consider when, and it comes back to when you're looking at your financial projections and what you want to do, identify when you need your funds, what the level of funding you require. Capital raises can run for smaller amounts anywhere between 3 to 6 months. I have seen it longer for higher levels of investment, and I would always advise, when you've done your cash flow forecasting, you've identified when you're going to get tight on cash, add 3 months onto that, and I'd work back from there, because what you don't want to get to is a point where you are tight on cash and you needed those extra 3 months, because it's not going to put you in a good position for negotiating the structure of the funding, and you may end up giving up more than you're willing to. So really think about the timing of it and just build in a little bit of a buffer. The other thing I would recommend is, when you're raising money, so you may do pre-seed or seed funding, for the owner or the founder, try and have majority holding in your company if you can, so that when you go to your Series A and you are taking in a higher investment amount, your dilution isn't too much. So that would probably be my other bit of advice there. And just one more, as it has come to mind, is think about what you want from the business, what you want from your future with the business. what you're willing to give up and what's your non-negotiable. So that when you are in your negotiations, you know where what you're willing to give up and not. Because you will have to give up a little bit more.
Right. Yes. Yeah. So it's sort of knowing what your long-term goals are for the business and long-term plan is for you personally to get from the business, and whether it's to maintain ownership or whether it's to sell ultimately the whole company. But it's really important to know that getting into it so that you know what shareholding and ownership structure you want to
But
retain.
yeah, and then if you know that, it will help you identifying the type of investor that you want in the business as well, because
Yeah.
you will know from the negotiations who works well for you. But if you don't do that exercise beforehand, you're going into it a little bit blind, and at a negotiation point going, oh, what do I actually want?
That's it. Yes, yeah. Yeah, and there's loads of horror stories there of the people that didn't get the advice at the start, and ended up with very little ownership of their own company and everything. So it's definitely an important consideration to really sort of know what you want and know where your line is.
Yeah.
Yeah, thank you for that, Georgina. That's helpful.
Um, so the next one, and I'm just going to go over valuation models pretty quickly, because we could spend hours on them, and there
Of course.
are different types that you can look at. So I've just focused on two. One is a little bit of a more simplified model, so the enterprise value multiple.
Okay.
And that's calculating the value of the company, and it's applying a multiple to the EBITDA. So that's the earnings before interest, tax, depreciation, and amortization. So the multiple that is applied, you are best to use data from, of course, comparable companies and transactions that have occurred in the same industry as your company. But make sure that, again, you're applying a multiple that's realistic, it's up to date. So just because, for example, 12 months ago, an 8x multiple may have been applied to a similar company, if in the current market for fundraising, for whatever reason, there could be macroeconomic impacts, but the multiple is now down at 4 or 5, for example, make sure you are adjusting, you're using most up-to-date data. If you feel no, our multiple is higher than that, well, what is the reason? Is it something extra that your company can add? Are you filling a gap? Are you solving a problem that's out there? So again, just make sure you're standing behind the multiple you're using. And then once you've applied that multiple, you're subtracting any debts, you're adding on your cash and cash equivalents to get the enterprise value of the business. So it is a much more simplified way of valuing your company. It is more reliant on that market-based data, which makes it easier to apply a valuation, but it can be less accurate, particularly if you're not properly matching companies and comparable transactions. So just bear that in mind. Then the other model is our discounted cash flow, so our DCF model. And with this one, you are projecting future EBITDA for a certain number of years based on the expected growth rates you've identified for the company and the assumptions to achieve that growth. So you calculate out your EBITDA and your cash flow for that. Then you calculate a terminal value. So with the terminal value, that's representing time beyond let's just say you've selected a 7-year period for your growth period, you're looking at the period after the 7 years. And if you're using the perpetuity growth method, you're looking at what is the stable growth and the stable cash flows after that period. Once you've set out your projected EBITDA, your terminal value, you then bring it back to the present value using a discount rate. You sum them all up and you get to your total enterprise value. You adjust that for your net debt or any other factors. So for example, for myself, when I was in tech companies, we would have then looked at what's the probability of some of the product development actually being achieved and revenue starting based on when we've projected it. So we would have tweaked it a little bit further again. So that's just a little bit of information there on DCFs. DCFs do require more detailed projections. So if you don't have that in-house finance knowledge, your advisor, your finance advisor would be able to assist with this.
Great. Okay. Thank you for that, Georgina. That's really helpful.
And then just to close it out, I suppose just a few key takeaways. Streamlining your operations and processes, whether you're planning on funding or not, it's invaluable to the business. Have your strong business and financial models in play and be realistic with your assumptions, your targets and your valuations. Building that strong management team. Again, it's so key whether you're funding or not. You want to make sure you're delivering on your plan as it is. Review, research the investment landscape and really align the type of investors to your organization and to your own values as well. And that is important. Develop your impactful, your pitch deck, your elevator pitch, practice it over and over again, tweak it, keep it snappy as well, because often you may only have 20 minutes with them and you tend to lose investors after about 20 minutes as well. And then have your documents and support ready to hand. It will just really build that confidence in your potential investor. So there's a lot of information there, and I hope I didn't lose you all too much throughout.
No, it was so insightful, Georgina. So thank you so much for sharing all of your advice and all of that information. It's really, really helpful, I'm sure, to all of our attendees. We have had some questions and an interesting one, I think. What would you recommend a new company not to do when applying for funds and presenting your business to possible investors? Is there any sort of go-to red flag that you should not do? And someone else has asked the same question. What are some common mistakes made by companies looking for funding?
Yeah, that's a good question. Look, I do think it comes back to being realistic in what you are presenting. It's a difficult one because you are there to sell your business and show the full potential of it and where it can even go above that potential. And I'm not saying don't do that. Really excel your company, but be confident in what you are presenting. Be sure you can support it, and also be humble when you are out presenting, because again, I have seen where people, they're so passionate about their business and they don't like to hear negatives or a different view that something mightn't work. So take it on board. I think that is important. But don't go in there unprepared and not being able to stand behind the information you are presenting.
Yeah, okay. I think that's really helpful and hopefully beneficial to those attendees who asked that question. I have had another question. What is the most efficient way for investors and for the startup to get funded tax-wise, through equity or through debt? They've asked for a loan or convertible loan in Ireland.
So here and again, as I was saying, I'm not an advisor within Fitzgerald Power. So if that person, did want to reach out, I can then direct them. But you do need to look at both avenues, and I would recommend getting somebody who's their core area of expertise is tax, because they will be able to best advise on it. But it is an interesting point, raising debt versus equity. And I didn't touch on debt today, but the one thing I would say is your fundraising and the type of funding that you get in doesn't have to be only equity or only debt. It's actually good for a business to have a mix of both. So again, get advice on that. Look at how your financial structure and your debt to equity ratio would look, and explore that. What I would say, particularly as convertible notes were raised, convertible notes are good if you are at a stage where you're too early to value the company. So a convertible note is good in that instance. And you would have VCs that would be open to it. And there's different types of convertible notes as well. There's one called a safe note, which is a bit more favourable to the founder as well. And it is something that's used in Ireland. But from a tax perspective, I would say I would get a specific tax advisor to advise on that.
Okay, yeah, that's really helpful. And I suppose essentially, good practice in terms of going for any investment, or, understanding how to optimize your own, equity in the business is really, that sort of key to that, is having a good tax advisor and working with them.
Yes, yeah, exactly.
Yeah, great, Georgina. Thank you. We've had another quite specific question from Andre there. What law regulates securities trading in Ireland? So we aren't here to advise on sort of the specific laws or anything. So I would say you'd probably need some specialist advice there. We have had another question. What is the level of investment usually made by private equity compared with venture capital? And they've asked what amount. But I suppose that's going to vary so hugely there, Georgina, isn't it?
It is, and it will come down to the mandates that private equity and venture capital have. Again, it will really vary. From what I've seen, generally private equities, they will. It's usually around the 5 million mark. I have seen it lower, and if it is a compelling case, and depending on the mandate, they are looking at smaller investments as well. So smaller investments are out there for them. VCs, it ranges so rapidly, from really small investment amounts to tens of millions or more. So their investment amounts, it is very much guided by their mandates, what type of industries they're looking at, what stage companies. So it's difficult to identify.
Yeah, and I think that's fair. And you've given as best an answer as you possibly can, sort of to keep it that level of general, because they do so vary, and probably venture capitalist funds vary so greatly as well, depending on whether they specifically work with very early stage or whether they do. And as you say, it's like, where in that 80/20 do you sit? Are they investing in you at that stage where they're going to expect that return and that return to cover the rest of their investments?
Yes.
Or whether you're very much at that sort of early stage where they allow for the first couple of years that there won't be a return, but that then you'll bring a huge return when you do get up and running.
Exactly. And particularly if you are a scaling company, or you've already scaled and you're going on to that next level, that's when the investment becomes much, much more significant as well.
Yeah. Yeah. Okay, great. Thank you so much for your time, Georgina. That's been really beneficial, I hope, to all of our attendees. Um, and I really appreciate you giving up your morning to spend with us. And thank you so much to all of our attendees for all of their questions as well. I do hope everyone has a great day now. And Georgina, hopefully we'll do another webinar together soon.
Sounds good, Christina. Thank you. And
Great.
thank you, everybody. It was a pleasure.
Yeah, thank you so